So let's analyze how the stock market mirrors the performance of the economy. Generally, the stock market performance is always a reflection of the performance of the economy. So that's the essence of this particular video. So stock market performance is often, viewed as a barometer of, the country's economic health. While it doesn't represent the entire economy, its movements generally reflects, various economic conditions and expectations. So below are key ways in which stock market performance mirrors the performance of the economy or the economy in general. Number one is corporate earning and economic growth. Corporate earnings and economic growth. So you discover that a strong economic growth typically leads to higher corporate profits, boosting stock prices. Conversely, when the economy slows down, it often results in a declining earning, and a declining earning per share will cause stock prices to plummet. It will lead to a market downturn. Number two is consumer confidence. Confidence. So a rising stock market often signals increased consumer confidence, leading to a kind of higher spending. And so lower confidence during market declines may result in reduced consumer spending, impacting economic growth. The more consumer spends, the more company revenue, sales or turnover will increase. And once sales increase, all things being equal, it will lead to increased profits and then increase in earning per share. So increased earning per shares will force stock prices to rise and vice versa. Number three is employment rates. Employment rates. So stock market gains can significantly, it can significantly indicate, kind of business expansion and hiring, reflecting lower unemployment rates. So market decline may indicate layoff or hiring freezes, suggesting economic contraction. So when the economy contracts, companies are no longer hiring. There's no buying power to really buy, then it will affect companies' turnover. Then there's that chain reaction. Number four is inflation and interest rates. Inflation and interest rate. You discover that the stock market reacts to inflation as well as central bank policies. They react to inflation and central bank policies. So lower interest rate often boost markets by encouraging investments, while higher rates can lead to market correction as borrowing costs rise. The cheaper the borrowing cost, the more people borrow, the more corporates, organizations borrow. But when interest rate is high, people tend to borrow less. And the lesser they borrow, the lesser they spend. And the lower they spend, the spending rates, the lower, corporate organizations would be able to make profits. Number five is investment and capital formation. Investment and capital formation. A booming stock market make it easier for companies to raise capital through equity issuance, supporting economic growth. When the market is doing very well, companies will always come in to raise capital. But when the economy is down, the flurry of capital raising activities will decrease, and that will reflects on the economy negatively. So a declining market can restrict access to funding, as is it will slow down investments. To slow down investments. Number 6, please don't forget to subscribe to this channel and like this video. Number 6 is the performance is sector performance and economic trend. Sector performance and economic trend. The performance of different sectors often reflects, broader economic trends. For example, rising industrial and consumer discretionary stocks may indicate economic expansion, while growth in utilities and healthcare may signal cautious economic sentiments. Number 7 is leading indicator for future growth. Leading indicator for future growth. Investors often anticipate future economic conditions. Thus, the stock market may rise or fall based on expected GDP growth, employment trends, or geopolitical factors. While growth in when all these factors are negatively affected, you would observe a kind of a change of direction in the economy. It serves as a leading indicator of of the direction of the economy. So all these indicators, GDP growth, employment, unemployment rate or employment trend, with all indicates the direction the economy is going. Number 8 is global economic influence. Global economic influence. Finance is global, particularly when it involves developed countries like the US, because whatever happens there most of the times tends to have a ripple effect all over the world. So global economic events such as trade agreements or financial crisis, influence the stock market. As we all know, the global financial crisis started in the US, and imagine it affected the whole world. So a strong global economy often correlates with a strong market growth, while global economic distress can trigger market downturn. So in conclusion, while stock market performance, is not a perfect, it may not be a perfect mirror of the economy, due to factors like speculation and market sentiment, but all the same, it offers a valuable insight into economic trends, investor confidence, and future growth expectation.